Hello, my friends. Brett Pattison coming at you from Iron Gate Global Advisors, located in the financial capital of the West, that is Salt Lake City, Utah. Thanks for tuning into this short video as we talk about what happened in the month of March, namely volatility, and what does it mean for April. To be a little bit more specific, we're going to address March returns from a sector and global perspective. And we'll take a look at what those year-to-date returns look like. I will highlight some surprises in terms of those returns, what we're seeing, and then some not surprises, I guess you could say, those things that we expected to happen and how we've positioned portfolios to take advantage. Then we'll talk about this big giant chicken that you see on your screen before you, and that is our sweet global chicken. For those that have been listening to me for the past 5, 6, 7 years, you'll kind of have an idea of what we mean by that. And for those that don't, we'll fill you in, and then we'll address April and what to expect in April. But if there's one way, moving on to March, if there's one way to view March, certainly it was volatility. Here's an old school pic of a old boat going up and down in the ocean, and that was March. Here's a picture of what March looked like, and I've got my cursor here, and it was just the beginning of March. We pulled back, then we rallied, then we pulled back, and typically March is an up month, historically speaking. It wasn't this month, and we'll take a look at those returns here in a minute, but certainly there was volatility and some fear among some of our clients that I hope to address today and to actually just relieve that fear as to what's happening, right? So there's March in a nutshell, and March globally looked like this. We had the S&P 500, which finished down 2.62% in March. The developed non-U.S., so your Europe, your Asia, down 1.58%. And then the emerging markets actually lost the less. And so they were the leading global markets for the month of March. They lost less than everybody else. And we're starting to see some strength in the emerging markets, which we'll address here in a moment. Year-to-date, from a year-to-date perspective, the S&P is up slightly, up 1.32%, and that's as of today, April 6th. Then the developed non-U.S. markets, which again, Europe and Asia, are up 8.58%. Emerging markets are up 6.76%. For the last couple years, we've had the U.S. markets outperforming everywhere else in the globe. This year, so far, now we're only a quarter in, but it's shaping up to be a lot different. We've seen the developed non-U.S. Crush it this year. And we're positioning portfolios and have positioned portfolios to take advantage of not only the developed non-U.S. markets, but also the emerging markets. And I've got to say this about the developed non-U.S., specifically Europe. All we hear about in the markets is how Europe all we hear about in the news, not in the markets, but in the news, is how Europe is going to be destroyed, how Greece is on fire continually. The news headlines don't change. How the euro is just getting hammered, which it is. But nonetheless, through all of that, the developed non-U.S. is up 8.58% this year. Now, of course, that includes Japan and that includes Australia, but namely Europe. And it's crushing it. Something to keep in mind for our clients and for those that are managing their own money is, and it's an important concept, and I come in here each and every month and I look back at the month of which just occurred, which March wasn't a great month. But I've got to tell you, from especially those clients that are worried about the market, I want you to focus on not just 1 month, but I want you to focus on the long-term picture, right, which is what we do. And you can see that's a 5-year chart of the S&P 500, the U.S. markets. And we're still in a tremendous bullish market. We have been for 7 years now. Some of these years not pictured in this chart, but don't get caught up into the CNBC and anything else that you're hearing about the bull market ending. We're seeing great strength from a fundamental perspective, from a technical perspective, and it's not just the U.S. anymore, but we're seeing those other markets catch up. You can't focus just on 1 month. And if there's ever any concerns about the market, you give me a call, right? Or an email at brett@igga.com, and I'm more than happy to relieve any fear that you may have or talk about different markets and what's happening. All right, but don't focus just on 1 month. Focus on the bigger picture, which is why we didn't exit any positions in the month of March, right? Why we're still bullish and adding to positions rather than dialing things back. All right, so how did the sectors turn out? Here's your March sector return. A couple things. I'm not going to go through those one by one. You can look at those. You can pause the video. You can look at them yourself. A couple things that I just want to highlight, and that was consumer discretionary, which typically leads this time of the year, which is what we're more overweight than anything else, was down 1.99%. Still outperforming the market in that it was down less than the S&P 500. But that's certainly one that stood out for us. Materials is one that's, it's either hit or miss with materials. It's either giant returns or just crap returns, it feels like. And that was down 5.88% for the month of March. Certainly what's happening in the market, we expected a better March than what we had. We didn't get it, but still no reason to panic just yet. Year-to-date returns are again what we expected in that consumer discretionaries, which were overweight, is outperforming everything else. That's what we expected to happen. The thing that we didn't expect to happen was the industrials. The industrials typically outperforms is actually lagging, and that's something that has been tied a little bit, really hurt by energy and energy getting hammered and really just hasn't caught up, right? You also have utilities, which is lagging the market on the year, an interest rate sensitive sector getting hit pretty hard. But overall, I would say sectors for the first quarter of the year are doing what we expected them to do, and the portfolios are benefiting as a result. Now, anything that I say here, obviously, if you're a client of Iron Gate Global, give me a ring and I can dig a little deeper. Everybody else, don't take that as recommendations in any way, shape, or form. But if you want more information, let me know. Now, as far as moving forward, there's two areas of the globe that we really like. We call it sweet global chicken. For those that don't know the saying sweet chicken, it's something that I developed while teaching people at Invest Tools from TD Ameritrade. So while I was at TD Ameritrade for 10 years, we developed this phrase that we called sweet chicken. And the sweet chicken is basically a plan that we have when put in motion begins to work. It's sweet. In fact, it's sweet chicken. It's not fried chicken, which is hard and bad for you and crusty, but it's sweet chicken. It's baked. It's healthy. It's good. All right, so here's the two areas of the market now that you know what sweet chicken means. Here's the two areas of the global market that we really like. And that is, again, not recommendations, but these are the areas we like. We love Europe and Asia, and we love China. And I'll highlight why. And I'm going to focus on Europe and Asia first. Here's a 5-year chart of Europe and Asia. We have what we call a bullish and bearish indicator, which is just a simple moving average crossover. Combines a 10 exponential moving average with a 40 period simple moving average. When the 10 is above the 40, we're bullish. When the 10 is below the 40, we're bearish. And what we're seeing now is, and I'm going to highlight that a little bit, for the last couple months. This is still a weekly chart you see here. But we're seeing the 10, which is the faster of the moving averages, move higher than the 40 period. And you can anticipate that happening, and you can start buying, VEA is the ETF that we're looking at here. You can start buying that ETF before that happens, which is great. But we've got that official bullish cross. In fact, it happened just a couple weeks ago. And that's a very bullish indicator for us. And so we really like Europe and Asia for that reason. We also like it because we are seeing from the ECB, we are seeing the same methods that the Federal Reserve used in tackling their growth issues, right? Namely, you could call it printing money. It's a little bit more complex than that, but call it printing money, right? And keeping rates very low to spur growth. Those same things that caused a 7-year bull market rally we're seeing in Europe. And so we're optimistic about Europe. Greece, we'll continue to hear about Greece. But from a valuation perspective, Europe is it's okay. It's not a great deal, but it's okay. And then, of course, we're seeing this technical indicator come in that we really like. So Europe and Asia, we love. China is also something that we love as well. Here's a 5-year chart on China. You can see, and I just drew a resistance line there on an ETF that tracks China, FXI. And it's breaking out to 5-year highs. And I'm going to zoom in a little bit more on what's happened recently. We had a pretty solid resistance there at 44, and it has broken that, and is flying off the handle. The Chinese government, is doing a lot right now to spur a bullish market in China, and they're doing campaigns for people to buy Chinese stocks. They're taking measure, they're taking a kind of an approach in China which is all meant to bring in outside money into China and the Chinese stock market. And they've done it before, but this is the first time in a long time that they've had these type of policies. And that combined with a very important fundamental reason, and that is the PE ratio of China is roughly about 10.1, which if you compare that to the U.S., which is sitting about 21, the Chinese markets are very cheap right now. So you've got two things happening. You've got a cheap Chinese market, which is a great screaming deal from a valuation perspective, looking at the PE ratio. You also have these economic policies that the Chinese government are bringing in to spur growth in the Chinese markets. And we really like China for those reasons. Now, not one reason above the other. Well, actually, I would say this. The core reason we like China is it's cheap and it's in an uptrend. Those are the two reasons why we love the Chinese stock market the most. There's different ETFs that you can look at, FXI being one of them. This doesn't mean go out and buy China if you don't own it. If we're managing your money, we got you taken care of. For those that are not, figure a good time to buy that Chinese market on a pullback if you're looking for a technical type of entry, or you may scale your way in if you're interested. But I'll leave that completely up to you. But those are the two areas of the globe that we really like right now. And if you are a client, look at your portfolio after viewing this video and you'll see what we're talking about. Now that the sweet chicken is in the oven and it's cooking, let's take a look at what we can expect from April. And it's very simple. And this was a tweet that I sent out on April 1st last week. And that was, since 1950, the average return for the S&P 500 in April is 1.5%. It's one of the best months of the year. We are expecting, if the probabilities historically are correct, we're expecting a very strong April. April's really the last solid month before the market starts its more defensive time of the year, which is what I'll talk about in the next video next month. But April is typically a very solid month. So don't get nervous. Don't start selling positions because you see something on TV that makes you nervous. Use history as a probability indicator and don't get caught up in the news and in the fear and what you may be hearing right now about the bull market ending, because that's not what we're seeing on our end. Again, we expect a strong April after this month of March and the volatility that we had. And so we're bullish moving forward, obviously. So we've just hit on a few different things, and more than happy to take questions if you want to email me at brett@igga.com. We just discussed March, what happened, what's leading and lagging for the year from a global markets and sector perspective. We talked about two areas of the markets that we really like from a global sweet chicken perspective. And then we talked about what we can expect in April, which is it should be a lot better than what we saw in March. Now, with that, I'd urge you to continue to look on our website in our education center at IGGA.com and take advantage of the free education and articles that we have written there. Everything from a market, what to look for when investing in stocks, to personal finance topics as well. And if you have any questions, there's my email. Jot that down, brett@igga.com. That's brett@igga.com. See my Twitter handle there and LinkedIn as well. I am constantly tweeting out thoughts on the market and also posting things through LinkedIn that are a lot of the time personal finance related, which is important for everybody to know and understand. So with that, we will talk to you next month. Thanks for listening.
This is a purely public broadcast and is not intended to be personalized financial advice for any individual's specific situation. Each individual's financial situation is unique, and the topics discussed on this broadcast should not be relied upon and or considered as personalized advice. Specific financial securities discussed are not intended to address any listener's particular financial situation and should not be considered recommendations. This is for educational purposes only. For more information, please contact Iron Gate Global Advisors at info@igga.com or by calling 888-591-0334.